Imagine two people. One has $20,000 sitting in a savings account. The other has $20,000 in credit card debt. At first glance, it seems obvious which customer a bank would prefer. After all, the first person has money. But in reality, the second person is often far more valuable to the bank because someone carrying debt can generate 10 to 20 times more profit for the financial system than someone simply saving money. Which leads to a strange question. If banks earn more when people borrow, why does the system make borrowing so easy and getting out of debt so slow? And once you start looking closely, something unusual appears. Many of the financial tools designed to help people manage money are also the same tools that quietly keep them in debt. To understand why this happens, we need to look at how banks actually make money. A few decades ago, borrowing money was usually associated with major life events: buying a house, starting a business, handling an emergency. But today, borrowing has quietly become part of everyday life. Credit cards pay for groceries and restaurant bills. Auto loans now stretch 6 or even 7 years just to keep monthly payments manageable. Student debt can follow people for decades after graduation. And now, even small purchases, clothes, electronics, food delivery, can be split into installments through buy now, pay later apps. In the United States alone, household debt now totals tens of trillions of dollars, spread across credit cards, mortgages, auto loans, and student loans. At first glance, this creates a simple explanation. People must just be irresponsible with money. But the reality is more complicated, because modern financial systems are not neutral. They are built in ways that make borrowing incredibly easy and staying out of debt surprisingly difficult, which raises an uncomfortable question. If debt is so expensive for consumers, why has the system evolved to encourage it so strongly? To answer that, we need to look at how banks actually make money. Because once you understand the mechanics, the incentives become surprisingly clear. Most people assume banks make money primarily by holding deposits. But deposits themselves are not the main source of profit. Loans are. Banks typically pay very little interest on the money customers keep in savings accounts, often around 1 to 2% per year, sometimes even less. But that same money can then be lent out at much higher rates. Credit cards frequently charge 18 to 25% interest. Auto loans may charge 6 to 8%. Personal loans can sit somewhere in between. The difference between what banks pay for money and what they charge for lending it is called the interest spread. And this spread is where much of the banking industry's profit comes from. For example, imagine a $10,000 credit card balance with a 20% interest rate. That balance alone could generate about $2,000 in interest every year. If the borrower only makes minimum payments, the balance can last for many years, which means a relatively small loan can quietly produce thousands of dollars in revenue. From the bank's perspective, a customer who carries a balance is not a problem. They are a customer generating predictable, recurring income. But interest alone isn't the full story, because modern financial systems have developed several additional mechanisms that make debt even more profitable. The first reason banks benefit from consumer debt is simple. Debt creates long-term interest streams. When someone carries a balance on a credit card, the bank isn't just earning money once. It earns money every single month that balance remains unpaid. This is where the structure of many loans becomes important. Credit cards, for example, rarely require the full balance to be repaid quickly. Instead, borrowers are typically asked to make a minimum payment, often just a small percentage of the total balance. That small payment keeps the account active, but it also allows the remaining balance to continue generating interest. Over time, this turns debt into something very predictable. As long as the balance remains, the interest keeps flowing. From the bank's perspective, this creates something extremely valuable, a steady stream of income that can last for years, which means a single credit card balance today can quietly produce revenue far into the future. And once you understand that structure, something important becomes clear. For banks, the most profitable customer is often not the one who pays everything off immediately. It's the one who keeps a balance. And this is only the first layer of the system. The second reason banks benefit from debt is that borrowing rarely exists on its own. Debt tends to expand into an entire financial ecosystem. When someone takes on a loan, it often creates demand for additional financial products. A credit card balance may lead to balance transfers. A personal loan may lead to refinancing offers. An auto loan can bring insurance products, service plans, and extended financing options. Each of these services generates additional fees, interest payments, or commissions somewhere in the financial system. In other words, a single loan rarely stays a single transaction. It becomes the starting point for a chain of financial relationships. From the perspective of banks and financial institutions, this is extremely valuable because the more financial products a customer uses, the more opportunities there are to generate revenue. Debt, in this sense, doesn't just create interest, it creates an entire ecosystem of financial activity built around the borrower. And once someone enters that ecosystem, leaving it can become surprisingly difficult. But the most powerful part of the system isn't interest or additional products. It's what debt does to human behavior. The third reason banks benefit from debt has less to do with mathematics and more to do with human behavior. Because debt quietly changes the way people make decisions. When someone carries a large balance, a credit card, a car loan, or student debt, their financial flexibility becomes smaller. Monthly payments become fixed obligations, and those obligations influence many other choices. People may delay changing jobs. They may avoid taking financial risks. They may prioritize stable income over uncertain opportunities. From the perspective of the financial system, this creates something extremely valuable: predictability. Borrowers with steady income and regular payments become highly reliable customers. But there is another layer to this dynamic that most people never notice. Because once someone enters a cycle of borrowing, escaping it can become surprisingly difficult, not only because of interest, but because of the structure of the system itself. And this is where the mechanics of debt start to matter. Because the way many loans are designed can quietly keep balances alive far longer than people expect. One of the most powerful mechanisms that keeps debt alive is something most borrowers see every month: the minimum payment. When a credit card statement arrives, it rarely asks you to repay the entire balance. Instead, it offers a much smaller number. Sometimes just 2 to 3% of the total balance. At first glance, this feels helpful. It makes the payment manageable. But the mathematics behind it can quietly stretch repayment over many years. Imagine someone carrying a $10,000 credit card balance with a 20% interest rate. If they only make the minimum payment each month, a large portion of that payment goes toward interest first, which means the actual balance shrinks very slowly. In many cases, it can take a decade or more to fully eliminate the debt. During that time, the borrower may end up paying thousands of dollars in interest. From the bank's perspective, this structure creates something extremely valuable: a loan that continues generating revenue month after month, sometimes for years. And the borrower often doesn't notice how slowly the balance is actually disappearing. But the minimum payment system is only one part of the structure, because the way interest compounds inside many loans adds another powerful layer to the system. Another mechanism that keeps debt alive is the way interest compounds over time. Most people are familiar with compounding when it works in their favor. For example, when investments grow in a retirement account. But with debt, the same principle works in the opposite direction. Interest is added to the balance, and future interest is calculated on that larger amount, which means the cost of borrowing slowly increases the longer the balance remains. For example, a $5,000 credit card balance with a 20% interest rate could generate about $1,000 in interest in a single year. If the balance isn't reduced quickly, the borrower begins paying interest not only on the original purchase, but also on the interest that has already accumulated. Over time, this can make relatively small debts much more expensive than people initially expect. And this compounding effect works quietly in the background, month after month. But the system doesn't stop there. Because once debt becomes part of someone's financial life, it often begins to expand into additional forms of borrowing. The final mechanism that keeps the system running is something many borrowers experience without noticing. Debt rarely stays the same size. It tends to expand. Someone may start with a single credit card balance, but over time, other forms of borrowing begin to appear. A balance transfer to lower the interest rate, a personal loan to consolidate multiple cards, a new credit line to cover unexpected expenses. Each step can feel like a solution in the moment, but it also increases the total amount of borrowed money moving through the system. And the larger that amount becomes, the more interest the financial system can collect. Over time, debt can slowly evolve from a temporary tool into a permanent financial structure. Not because people planned it that way, but because the system makes borrowing easy and repayment slow. And this is why understanding the incentives behind the system matters so much. Because once you see how these mechanisms work together, the goal becomes much clearer. Not just managing debt, but avoiding the structures designed to keep it around. None of this means that banks are villains. Banks are businesses. And like any business, they respond to incentives. The modern financial system rewards lending, which means it naturally encourages borrowing. Credit cards, loans, and financing tools are not necessarily bad on their own. In many situations, they can be useful. But the structure of the system makes one thing very clear. Debt is rarely designed to disappear quickly. It is designed to remain active long enough to generate revenue. Once you understand that, your perspective on borrowing begins to change. Debt stops looking like a harmless convenience and starts looking more like a tool that needs to be used carefully. Because the real advantage isn't avoiding every form of borrowing, it's understanding the incentives behind the system and choosing when to participate in it and when to step away.